Most likely, some of these people who express fears about being around transgender people have probably been around transgender people and have shared spaces with transgender people. They just might not have known it.
It was somebody from Washington, D.C. who had never spoken to me. Had to Google who she was, as I got this. And I was like, cool, so this is disingenuous, and this is arbitrary, and this is not on performance. This is across-the-board termination.
The thing that has to happen first, before we take any policy initiatives, is we have to change hearts and minds, and we have to basically uncover the history, a history that's been lost and obscured. Just the idea that Jim Crow was regional is basically what most people think, and it wasn't.
Welcome back to the Metro on WDET. I'm Robin Vincent. Volatile. That's the word economists are using to describe what's happening in the markets. Last week, President Trump placed double-digit tariffs on many countries around the world, including those in Europe, China, Japan, among others. From there, chaos ensued. The markets tanked. 2 days later, the stock market lost over $6 trillion. But then yesterday, things changed. Trump paused his tariffs for 90 days, with the exception of China, which saw its tariffs increase to 125%. And the markets bounced back. The Dow ended over 2,900 points higher. The Nasdaq jumped 12%. Conventional economists argue against tariffs. They say trade is generally good. It makes both countries richer in the deal. And they often don't like tariffs because they increase prices and make it harder to get the materials countries need to build and sell stuff. Now, one thing experts say we need to build more of is homes. And to do that, we need softwood lumber, which often comes from Canada, and drywall material, which we often get from Mexico. So if prices on those goods go up from tariffs, building homes will become more costly. A minority of economic thinkers are pushing back. They're saying we have to give these tariffs time, that the market and American companies need a while to restructure themselves to this new economic order, and that we have a trade deficit with many countries that we need to undo. Are they right? For the rest of the hour, we're trying to understand how Trump's tariffs are impacting people of all ages. And we want to start with young folks who want to buy a home. To discuss this, we have Chen Zhao here. She leads the economics team at Redfin, which is a real estate firm. Chen, welcome to the Metro.
Thanks so much for having me today.
And we also want to hear from you, our listener. Are you a young person wanting to buy a home? Do you think this is a good time to buy, or is all this market craziness giving you pause? The number is 313-577-1019. Now, Chen, I want to start here. Broadly speaking, what's the connection between tariffs and the housing market here in the U.S.? How do tariffs influence home construction and home buying?
Sure. There's a few different channels that we should think about. The first is that, as you just spoke about, tariffs increase the prices on things that we need to build a house. So whether that's, lumber or drywall materials or appliances or other things, they're a really critical part of the home building process. So increases in those prices have a dramatic effect on the cost of building homes and can decrease the supply of homes at a time when we're already at a critical housing shortage. And that means higher prices for everyone at a time when affordability is already a huge issue. The second channel that we have to think about is really mortgage rates, right? So as we have seen the last few days, tariffs can wreak havoc on markets, not just the stock market, but also bond markets. And bond markets are what determines mortgage rates. So in particular, the inflationary concerns that we have with tariffs mean higher rates. And so that means mortgage rates staying higher for longer. Now, there's some argument around, will that be temporary? Will that pass? Does the Fed really need to keep rates higher? That's that's up for debate, but we do know that tariffs increase inflation, and that's not something that we or the Fed can really easily ignore. The third channel that we have to think about is really what's going to happen to, the economy. So what we also know about tariffs is that they decrease economic growth and increase unemployment. And so even though, it's been widely reported that President Trump paused the tariffs yesterday, or implemented a 90-day pause on most of the tariffs, what I think a lot of the media reports have actually missed is that because we increased the retaliatory tariffs on China by so much, and because China is the US's third largest trading partner, that effect is actually larger than pausing the retaliatory tariffs on the rest of the world. And so what that means is that today, as we stand this morning, the average tariff rate in the United States is higher than it was on Liberation Day on April 2nd. And that it still exceeds 20%, which means it's still the highest in more than a century, which means that there is still a considerable recession risk associated with these tariffs. So, different economists will tell you different numbers. I would put it, the odds of a recession right now in 2025 at 40 to 50%. And that is very significant for anyone who's considering buying a house right now.
Wow, Chen. So I just want to emphasize what you're saying here, which is that the pause on most tariffs doesn't, in your eyes, mean that much given how high the tariffs have been increased on China.
Yes, that's right. China is the U.S.'s third largest trading partner. So the fact that right now, I believe our tariff rate on China is 125% as of this moment, that just has a huge effect.
Chen, what do you make of all the pausing and starting of tariffs? What does that do to the housing market?
That's a really great question, because I think that's something that is perhaps also a little bit underappreciated, is that every time you swerve left or right, that leaves lasting damage for the economy, because it's really hard for consumers and businesses to make big decisions in the face of so much uncertainty. So for businesses, that means hiring or making investments. Where are they going to be building their supply chains, for example? For consumers, it's really large purchases, and the largest purchase that people make is a house.
That's right. So this takes us back to that word volatility, that all of this inconsistency makes it hard for companies to plan, to build, and employ people then.
Yes, that's right. So if you're thinking from the perspective of a builder right now, and you're trying to decide, how many homes do I want to build? What are my margins going to be looking at? You need to know with some amount of certainty, what is going to be the cost of my input materials, right? And over the last few months, we've, put tariffs, 25% tariffs on Canada, Mexico, and then we've taken them off, and then we put them back on, and then we exempted everything that was covered under the USMCA, which includes the lumber. But you're also thinking about, hey, what about all those appliances and other materials that I import from China, right? And those tariffs, were 20%, then they were 50%, then they're 80%, now they're 125%. Like, what is it going to be next week? It's really, really hard to make any sorts of plans as a business leader in such an environment.
I want to zoom in, if we could, on young people who are really struggling to purchase homes right now because there's simply not enough supply of housing. How have the tariffs affected the growth or decline of home building? I mean, what do the specific numbers on home building and construction look like?
So right now, construction is much lower than it was a few years ago. We saw a little bit of a boom during the pandemic because there was so much demand. But starting in 2022, when mortgage rates started really rising, builders started pulling back, understandably. They didn't pull it back probably as much as people would have expected because the other side of the market, existing home inventory remained really low. That means that, homeowners are, largely locked into these really low mortgage rates. They're reluctant to move and give that up. So there's not a lot of people selling their homes. So builders sort of stepped in to fill in that gap a little bit. But looking forward, given the kind of prolonged expectation of higher mortgage rates, we do expect building to remain pretty subdued. And we're seeing, the challenges that young people face in our data. For example, we see that only about a quarter of adult Gen Zers own a house in 2024, and that's been flat since 2022. And similarly, for millennials, we also see that only 55% of millennials own their home in 2024, and that was also unchanged from 2023. And that was a figure that had been rising ever since 2012. So we're seeing this progress for millennials and Gen Zers really stall in these last couple of years due to the lack of supply and due to the high costs associated with buying a home.
Would you say, though, if interest rates are low, could it be a good time to buy even if the market is inconsistent?
So if we enter a scenario where economic growth is slow, maybe we call it a recession, maybe it's just a slowdown or something like that, and it is the case that we don't have high inflation, so the Fed is able to cut rates, so we see lower mortgage rates, then is it a good time to buy? Well, I don't know. It depends on each person's individual circumstance, right? So recessions or slowdowns tend to hit pretty inconsistently from household to household. For some folks, we saw this during the COVID recession. It was largely blue collar workers or lower income households that were hit the hardest, while higher income households were largely spared. And we had a housing boom during that time. So for some folks, it might feel fine if they feel very economically secure. However, for others, making such a large purchase, tethering yourself to a 30-year mortgage, could be the worst thing to do in such an economic environment.
This is the Metro. I'm Robin Vincent. We're talking about President Trump's tariffs and how they're affecting the ability of young people to purchase homes. We're speaking with Chen Zhao, a lead economist at the real estate firm Redfin, and we want to hear from you. Are you a young person, a first-time home buyer? Do you think this is a good time to buy, or is all this market craziness giving you pause? The number is 313-577-1019. Chen, considering that we're not building more homes quickly enough, should young people still mostly be focusing on interest rates? Is the best indicator of whether to buy or not if the interest rates are low?
I don't think interest rates are going to be the only indicator, moving from here on out. I think people will need to think about really just greater economic scenario because, mortgage rates are one part of the equation, but home prices are the other part of the equation for affordability. So if, depending on what happens to economic growth, are we in a recession? What happens to the unemployment rate? Home prices could keep rising as they have been these last few years. They could stay pretty flat or they could even fall. All of these are possibilities. We're really in a time when things are very, very highly uncertain. So mortgage rates are important, but it's not the only piece of the puzzle.
I want to go back to something you said about the likelihood of us approaching a recession. And you're right now forecasting we're at about, 40 to 50% likelihood of that? Yeah? Okay.
Yes, that's right. Yeah.
So what would a recession, can you talk a little bit more about what you think it would mean for home ownership rates for prospective homeowners?
I think if we do hit a recession, home ownership rates would probably stay pretty consistent. Those tend to stay fairly flat over time. They don't tend to move a lot. What we will probably see is that you won't see a lot of first-time home buyers buying at the same rate that they previously were. Those are the folks who tend to be hit the hardest, where, you still might see move-up buyers or people who are already existing homeowners, sell and then buy again, for example. And the reason is because existing homeowners are sitting on a lot of home equity right now, really record amounts, because we had this massive home price appreciation during the pandemic. And we've also had very strict mortgage underwriting standards, which means that not a lot of folks, are sitting at very high loan to value ratios. So people have a lot of wealth in their homes right now. But the people who are really facing the hardest time and will continue to would face the hardest time in the event of a recession are younger people who are more likely to be first-time homeowners and who don't have that housing wealth to rely on.
Can you talk about then the cascading effects that this would have on the economy? Because we know home ownership is so important when it comes to building wealth. So if we see this kind of stagnation when it comes to young people and first-time home buyers, what are the broader impacts you see on the economy?
Sure. Yeah. I mean, you're absolutely right that, what economists like to say is that the housing market is one of the primary channels through which the Federal Reserve, for example, tries to influence what we call the real economy, meaning the Federal Reserve can move, their federal funds rate, but they have to think about how does this actually affect everyday people. And one of the main ways is through housing, because mortgage rates are so sensitive to the Fed funds rate. So, if we're in a situation where mortgage rates are able to fall, then the Fed, would be hoping to stimulate housing. But housing is kind of in this really unique situation right now where it's not clear, how effective that would be, essentially. And what that means for the broader economy is that, these types of events can be very starring, right? Because if people aren't buying homes, that, has an effect on builders, it has an effect on the people who are employed by builders, it has an effect on companies that, produce goods that are associated with, home ownership. So for example, furnishings or appliances or, things like that. And all the people who are employed by those businesses will be affected too. So, there's this cascading effect that goes through the economy when an industry such as, as large as the housing market is, suffers a downturn.
Now, for people who want to see these tariffs go into effect, which spans from Trump supporters to union leaders like Sean Fain of the UAW, who wants to slow or stop globalization, then there are certain right-wing economists like Orrin Cass. They say that America should implement tariffs. They should just go a little slower and we should expect there to be some chaos up front. What would you say to them?
I would say that there is no economic case for implementing tariffs, certainly not tariffs at the scale that we're talking about right now. Before President Trump's second term started, the average tariff rate in this country was 2.5%. Right now, we are well over 20%. It is just a huge, massive shift. And if you talk to economists and you look at economic studies, there are very few topics or questions that economists really agree on. Almost every single question you'll find disagreement in the field. This is I think the only one that I can really think of where the vast, vast, vast majority of economists agree on this issue. And if you look at credible empirical studies, they all tell us a very consistent story, which is that free trade is beneficial to the economy, that increasing tariffs the way that we are doing it right now will increase unemployment, it'll decrease economic growth, it will increase inflation. If there is a hope to bring back certain manufacturing jobs, what we have to remember is that for every one person who is employed in an industry that manufactures a specific thing that we are putting the tariff on, there are multiple people who are employed in industries that use that product as an input good. So this has a huge negative effect that is on a much larger swath of the population. So there is no economic case for expanding tariffs like this.
I have been struck by tariffs being this unifying topic among both liberal and conservative economists. So I appreciate you pointing that out, Chen. Since interest rates matter so much, I want to close by asking, what would you do if you ran the Federal Reserve? If you controlled interest rates, would you raise or lower them during all of this chaos?
I guess I should start by saying that I do not envy Chair Powell for the job that he has and how difficult of a position he's in. What tariffs bring about is really the Fed's worst case scenario. It's higher unemployment at the same time that you get higher inflation. So what do you do in a situation like that? I think the Fed is very likely to take a very cautious approach, meaning that they're not going to assume that the inflation is temporary or transient, and they will wait to see what the inflationary impact is before they do any sort of cutting to help with rising unemployment. And I think that is probably the right path to take. But I think the Fed will be very data dependent, as they like to say. They're going to be monitoring the data very carefully. And I think, they're doing the right thing.
Chen Zhao leads the economics team at Redfin, which is a real estate firm. Chen, thank you so much for joining us on the Metro.
Of course. Thanks so much for having me today.
This is the Metro on WDET from the WDET newsroom. The U.S. Senate has confirmed President Trump's nomination of former Michigan Congressman Pete Hoekstra as ambassador to Canada. The former head of the state's Republican Party served as ambassador to the Netherlands during Trump's first term. During his confirmation hearing, Hoekstra downplayed Trump's threats to annex Canada, saying it's a sovereign nation and pledging to strengthen ties between the two neighbors. Both of Michigan's Democratic senators voted in favor of Hoekstra's nomination. Coming up next, have you seen your retirement savings tumble as the stock market's taken a hit? Are you making any changes in your life as a result? We'll take your calls and speak with a financial advisor. This is the Metro on WDET. Stay with us.
About Detroit, I'm talking about the neighborhoods. I'm talking about Deep West, Deep East, Northwest, Southwest. There's experiences that come from those communities that are very important to understanding the experiences of all Detroiters.
There's so many good artists in Detroit. Everybody is not going to become nationally known, but when you go, you just hear really wonderful music.
We've got the beat of the nation here in Detroit because here we have people that work together of all races, of all religions, who in this cosmopolitan area have found a way to solve our common problems. That is the lesson of Detroit.
Welcome back to the Metro on WDET. I'm Robin Vincent. A number of recent retirees and those who are nearing retirement are concerned right now. That's because the stock market has taken a hit and has generally been chaotic. For many people about to retire, they rely on a strong market where they have a lot of money saved through 401ks. Now, in the last segment, we discussed how young people are navigating the volatility of the stock market. And now we want to turn to people who are retired or those who are about to be. And we want to hear from you. Have you seen your retirement savings tumble with the stock market? Are you making any changes in your life as a result? The number is 313-577-1019. And we have Bobby Barrett here. He's a financial advisor for Raymond James in a Birmingham office. He's here to discuss what he makes of this chaos and the kinds of things he's advising his clients. Bobby, welcome to the Metro.
Good morning. Thanks for having me.
And before getting started here, we should note that any opinion of Bobby's are not necessarily those of Raymond James, and that prior to making an investment decision, you should consult with your financial advisor about your individual situation. Had to get that disclaimer out of the way, Bobby.
Appreciate it. Thank you.
So last week, Trump declared April 2nd Liberation Day. That's when he put double-digit tariffs on many countries around the world, including those in Europe, China, Japan, and many others. Now, from there, chaos ensued. The markets tanked. 2 days after Liberation Day, the stock market lost over $6 trillion in value. And then yesterday, Trump walked back his tariffs, limiting them to 10% on most countries for 90 days, with the exception of China, which saw its tariffs increase to 125%. Now, as a financial advisor and as someone who studies the market, have you ever seen anything like this?
I think the tariffs might be different, right? If you look at history of the markets over time, there's always going to be different events or different causes for these declines that we go through, right? A common saying in our industry is, there's always going to be a reason for, you or I or anyone out there not to invest, right? But what I think history has shown is over the long term, if you can stick with some sort of game plan, right, when it comes to your finances and when it comes to your investments, the market's going to reward you over time for being able to put money away. But exactly what you said. I mean, you threw out some big numbers right now. There's a lot that we're going through. Uncertainty is never fun, no matter what industry we're going through. And especially, with right now, the number one thing with uncertainty is you can't panic, right? Especially for those that are, thinking about retirement or in retirement right now. We can, we know how you feel, right? But the important thing throughout this, the common thing that we're telling all our clients is you can't panic through this, right? The market, the tariffs, it's going to be what it's going to be, right? We try not to get too political, right? Presidents are going to come and go, recessions are going to come and go, corrections are going to come and go, but the market and investing have rewarded those who have been able to get through those temporary declines, right? Because they are temporary, and the market will always rebound.
Bobby, you sound well rehearsed in being the calm amid the storm. I am guessing that you've been hearing from some folks who are freaking out a little bit. Can you speak to that?
I can, yeah. I think it's always important to put what's happening right now into perspective. And the way we do that is we tend to look back at history, right? If you look back at the stock market, right? And when I say stock market, I'm referring to the S&P 500, right? It's a broad, represents the 500 largest companies across the U.S., right? And if you look back to the 1980s, the market annual returns have been positive 34 of the last 45 years. But every year on average, there's a intra-year decline of roughly 14 to 15%. So every year we're expecting some volatility, right? Some years you don't feel it as much, right? We've had 2 really good back-to-back years of stock market returns, which, frankly, people have gotten used to, right? And then this year, with all the tariffs and everything, it's kind of turning everything on its head. But I say that stat just because it puts volatility is normal, right? It's temporary. Declines are temporary. And you've got to, I think the big takeaway from anyone listening is you've got to have some sort of game plan, right? You've got to have a financial plan that's going to help get you through this. And get you through these declines as we go through them.
So you're encouraging people to zoom out and to look at the bigger picture of things and to look back and to look forward. But I am wondering, with all the starting and stopping of tariffs, how that has specifically changed the way that you might be advising your clients, if at all.
Yeah, absolutely. And I had my team put together some stats. And to put things into context, it's been the fifth worst start to the market until April that we've gone through since the 1930s, right?
Wow.
So it's a lot. It's a lot to take in, right? And people are rightfully concerned, right? No one likes to see their portfolios go down in value. But if you take a look, what we're trying to focus on with clients right now is say we're focusing on the long term, right? And that doesn't mean we're not doing anything. Right. So over the last 2 years, we've had really good returns. We've been talking to clients about taking profits, right, when their stocks have been up. And what that looks like right now is, as the market is down, maybe you are considering taking some profits from your bonds, which have held their value, and shifting that more into stocks as they are down, right? The stock market is funny, right? People like to look at it a little bit differently. I mean, if you look at it as the market being down, the market's on sale, right? I joke with clients, if you're buying towels, right, would you rather buy them on sale or would you rather pay full price? Everyone wants to buy them on sale. But the stock market is funny when things go on sale, people they tend to run out the door or, panic or, consider selling their long-term investments and abandon their financial plan that they have, which is the worst thing you can do.
We're looking at how stock market volatility from tariffs is affecting retirement savings right now. And we want to hear from you. Have you seen your retirement savings tumble with changes happening in the stock market? Are you making any changes in your life as a result of the chaos? The number is 313-577-1019. Our guest is Bobby Barrett. He's a financial advisor at Raymond James in a Birmingham office. Now, Bobby, are you worried about the value of bonds going down? If less countries around the world invest in the American dollar, will that hurt the value of bonds?
Potentially, right? I mean, it's hard to predict what the outcome is, right? I think what we're telling a lot of our clients is we respect the unknown right now. There's so much change that's taking place. I mean, even this week with the tariffs changing from week to week. So I think what I would tell your listeners is you've got to have some sort of long-term financial plan. If you don't, go online or consult a financial planner or a professional, right? Because at the end of the day, the market and the economy is, it's really hard to consistently predict what's going to happen. And it's even harder to try and time what's actually going to happen going forward as well.
What about if you're someone living on a fixed income and a lot of your retirement money is in the stock market? What would you recommend that person do right now?
I think the biggest thing, right, is what we're seeing as far as retirement planning is people are generally living longer nowadays, right? You've got to, retirements are 30 plus years, which is great, but you also have to plan around that. So, I think first and foremost, what we would be talking to those clients about, those people about, is making sure you have enough cash on hand for the next 6 to 12 months to cover your needs, right? And that's going to help you not make drastic decisions when it comes to having to sell your long-term investments to support yourself, right? But I would also say, while the market broadly is down to start the year here, as we get good days where we get bounce backs, if you don't necessarily have enough cash on hand, use those days to raise some cash. But don't be afraid to also, take from your conservative investments and add to stocks even when they are down, because that's the best thing you can do.
Bobby, I'm going to ask you to be very candid here and tell me, what are the conversations that you're having right now with other financial advisors? What are they most concerned about?
I think everyone right now is just making sure you're talking to your clients, right? Clients want to hear from us, right? There's a saying that we always talk about is, clients don't know how much you care unless they're hearing from you, right? So the most important thing is we're trying to put everything into context for them, what's happening in the world, and it's changing fast. But one thing we're doing is we're reviewing their financial plan, right? Because if you don't have a plan or a roadmap to kind of get through these turbulent times, you're going to make some costly mistakes along the way, right? And we don't want that to happen.
If someone were putting together a financial plan, let's say right now, amid all this chaos, which sounds like a little bit of a daunting task, but maybe a necessary task. I mean, maybe this is making some folks think, I really do need to have a financial plan in place. What would you suggest to a younger person?
Yeah, I mean, in our view, everyone should have a financial plan. All of our clients, we start by creating a financial plan, and we use that as our roadmap to, how much risk they should be taking with their investments. Now, these last 2 years, we've had really good returns, but the volatility that we've seen so far, has, brought back up the importance of having, that conversation about risk and how much you're willing to take. And so I would say no matter if you're in retirement or younger, having some sort of plan in place, right? So you know what it's going to cost, what you need to live off of, it's enough. Two of the common questions that we usually get asked, right, especially with people getting close to retirement is, am I going to make it? Do I have enough, right? So we have to sit down with them and first define what it is, right? What their goals are, what they're trying to accomplish. And then we can map out a plan, right, that takes a look at, what they have saved up until now and what recommendations they should be making going forward.
Before we let you go, Bobby, the market, it shot back up yesterday. When that happens, does that actually make you nervous? Is it consistency, like a consistent trend of the market going up, better to see than sort of that sharp upward trajectory?
Yeah, I think, we get questions all the time, right? The important thing is you got to remind yourself that you can't time the stock market, right? It's going to do what it's going to do, right? These declines are always temporary. They actually did a study looking back the last 20 years, right? And if you take the average return of the stock market, which is roughly 9 to 10% over that 20-year time period, and you were just fully invested that whole time, if you miss the best 20 days in the market, your returns on your investments dropped in half. That's how much it can affect. So I stress this for all your viewers out there, have a financial plan. If you don't, speak to a financial professional and get a plan in place.
Bobby Barrett is a financial advisor for Raymond James in a Birmingham office. Bobby, thank you for joining us on the Metro.
Thank you for having me.
Coming up, weight loss drugs are changing healthcare in America. What will it mean for our country's health in the long run? We'll take your calls, 313-577-1019. This is WDET-FM, Detroit Public Radio, your connection to news, music, and conversation.